Welcome back to NYSE Live, everyone. I'm Kristen Scholler here above the trading floor. And with summer now in the rearview mirror, the big focus this month is what will happen with interest rates or borrowing costs. Well, if you own a home or aspire to be a homeowner someday, this segment will certainly matter to you. Intercontinental Exchange, the parent company of the stock exchange, released its latest monthly mortgage monitor this morning. And joining me now to break down what the data means for you is Andy Walden, Vice President of Enterprise Research Strategy at Intercontinental Exchange. Andy, welcome.
Hey, thanks, Kristen.
It's great to have you on the show here. And I think what our viewers are probably wondering most of all is it any more affordable to own a home these days?
Yeah, it's a great question, right? And the needle has moved in the right direction over the last 90 days or so. If you look at what's happened with mortgage rates, they're now down well over 0.5% from where they were just a few months ago, with the majority of that improvement coming over the last 45 days. And if you look at what that means in terms of buying the average price home across the U.S., it's reduced the monthly payment required to buy that median home by about 145 days over the last few, or $145 over the last few months. It's made housing the most affordable it's been since February. So certainly still a challenging environment. I think we all know that. There are a handful of markets that are back to those normal levels of affordability. The bulk of the country is still taking 10 percentage points more of the local market income to afford the local home than it traditionally does. But the needle's certainly moving in the right direction here as we move into fall from an affordability perspective.
How are we seeing Americans take advantage of these lower rates, Andy?
That's a good question. And on the refinance side, you're seeing the number of folks that could benefit from a refinance roughly double from where we were a couple of months ago. Now, we're still at historically low levels, but you've seen some improvement there. You've seen a corresponding rise in the amount of rate term refinance activity taking place out there in the market. So you are seeing that pick up again a little bit here, hitting its highest levels over the last couple of years. However, when you look at it from the purchase side, right, and purchase mortgage demand, we've seen 3 of our best weeks since March on a seasonally adjusted basis. But it's been a little bit more of a measured response to this improvement in affordability compared to what we saw early this year when rates fell, and especially early 2023 when rates fell as well. And so some positive movement in terms of purchase demand, but some more measured movement, which is, I think, a good thing as we move into this upcoming Fed meeting.
Interesting. I am curious to get your take on what the data, the treasure trove truly of data that you have access to, we have access to at Intercontinental Exchange, does show us about how it may impact the Fed's decision on rates September 18th.
Yeah, and I think broadly, when you look at the market, you're seeing a lot of positive signs. If I'm looking at the market from my Fed-colored glasses, a couple positives stand out to me. One, home price growth is slowing down over the last few months with our slowest annual home price growth rate in a year. That's good news for Fed as they try to control shelter costs out there in the market. And then that more measured response to falling interest rates in terms of purchase demand. We've seen in past instances where interest rates have fallen, it's kind of reheated the housing market, and even at these relatively higher interest rate bands. This more measured response, I think, is a positive sign for the Fed as well, that they can begin to reduce interest rates without as large of a risk of reheating that housing market like has happened in early 2023, and even to a modest degree earlier this year as well.
How are we seeing different markets across the country perform in relation to each other?
Yeah, and really there's a clear differential in what you're seeing across the country. Midwest and Northeastern markets are much stronger, much firmer from a home price perspective. In the Midwest, because of relative affordability in those areas of the country. In the Northeast, just simply because there isn't any supply up there. And so those are the areas where you're seeing stronger home price growth rates. I think where a lot of eyes are right now as we move into the tail end of this year is the Sun Belt region of the country, especially Florida. When you start to look at supply growth, you've seen some of those areas that now have 50 to 80% more supply than we had at this time last year. And when you look at that latest ICE home price index for July, what you're seeing is that, the largest 9 markets down there in Florida are seeing prices come down by at least 0.25% in a single month. In some of those more extreme examples, your Northports and your Cape Coral Floridas, you're seeing roughly a full percentage point decline in home prices in a single month. Prices 6 to 7% off of where they were at their peaks. And so you're certainly seeing some softening when you get down there into some of those southern markets, especially in the state of Florida.
You know, we've seen inventory being an issue even before the pandemic. The lack of supply of available homes on the market pushing up the overall price of a home. Are we seeing any easing on the inventory front? What does the data show?
Yeah, we are. And that's been one of the bright spots for the housing market really throughout 2024. We've seen inventory gradually returning out there. We've seen it in each of the last 5 or 6 months. Now about 37% more inventory than we did at this time last year, of 5% month over month, the shallowest inventory deficit that we've seen since kind of the middle stages of 2020. So the needle is moving in the right direction. The more concerning thing when you look at inventory is the growth is really coming from softer demand that's allowing homes to sit a little bit longer and for that inventory to grow. When you look at existing homeowners and their willingness to list their homes for sale, we're seeing some of the weaker levels that we've seen over the last 12 months. And so that makes you a little bit more sensitive to interest rate movements and resurgence in demand. So certainly something that'll be watched closely, but returning inventory has been a bright spot throughout this year.
For viewers following along at home, Andy, or online, how much data do you have access to produce this mortgage monitor that does give us a glimpse really into the entire country?
Yeah, it is a great question. And really, we see the majority of loans being originated across the country, the majority of actively serviced loans, not only on a monthly basis, but in the bulk of those cases on a daily basis, what's going on with lending activity out there, what's going on with existing homeowners and with existing mortgage holders. And then when you look at that housing market data, it's really built on one of the most robust public records data sets across the country. And then we feather in some MLS data and mortgage data as well. So you're really getting a robust look at what's going on in the mortgage and housing markets on a day in and day out basis.
Andy Walden joining us with the insight with the monthly mortgage monitor. Andy, thank you.
You bet. Thanks, Kristen.